In this video, we're going to look at how to build an easy starter portfolio, the benefits of this portfolio, and why this is a really good way to start on your investing journey. Hi there, welcome to my channel, where we talk money and having more of it. In this video, we're going to put together an easy starter portfolio. The starter portfolio is built by investing in 3 low-cost assets, which are typically low-cost index funds. This is an uncomplicated portfolio that requires minimal maintenance, saves you the cost of having somebody else do it for you, and gives you the opportunity to learn about investing as you do it. It involves 4 steps. And the first step is deciding your asset allocation. The second step is selecting your funds. The third step is choosing the allocation between these funds. And the fourth step is setting up your monthly investment amount. Let's start by taking a look at your asset allocation. The tried and tested approach to starting your portfolio is to have a clear strategy around how long you will be investing. And this really is just the time you figure you're going to need to reach your goal. And the second thing is your level of risk tolerance. So basically, if you're going to be invested for less than 5 years, don't put your money into the stock market. Rather keep it in savings to avoid the disappointment of a potential down market when you want your money. The longer you have to invest, the more time your investments have to grow. Your risk tolerance speaks to how much you want to invest in the risky assets in your portfolio versus the lower risk assets. Shares, which are otherwise known as equities, are considered the high risk assets because they have higher volatility, and this simply means that the share prices go up and down a lot, but they also have the potential for higher returns. Bonds, which are like a loan to a government or company, earn a fixed return and are considered to be less volatile and less risky. A back-of-the-envelope approach to asset allocation is to assume that the bond allocation within your portfolio is equal to your age. And if you're younger or have a higher risk tolerance, you can adjust your bond allocation down by between 10 and 20% to account for this. If, on the other hand, you are nearing your time to retirement or your goal, or you have less tolerance for risk, you could similarly increase that bond allocation by 10 to 20%. Once you have your asset allocation decided, it's time to select your funds. When it comes to selecting the funds, you'll want index funds with a low expense ratio so that you can keep the cost of your portfolio low. An index fund pools money from multiple investors to buy individual stocks, bonds, or securities that make up a particular market index. For example, in the UK, the FTSE 100. They are low cost because they simply match the performance on the market without having the high cost of a manager trying to outperform it. The expense ratio is the cost of the fund, and it's usually charged as a percentage on the value of the fund. The advantage of index funds is that you immediately have a diversified investment across all the pooled assets in the fund, and you don't have to go out and do individual stock picking. This means you will match the return of the index you are tracking. This is not to say you can't go and do a bit of stock picking outside of your 3-fund portfolio either. In the US, the 3-fund approach can be built from either funds or ETFs, exchange-traded funds. But in the UK, beware, because your broker may charge you a commission on the ETF because they trade as shares. And this means that they are sub-economical when you want to add regular amounts to your investment every month. The brokers seldom charge the same amount on funds. So be careful when choosing between the fund or the ETF, and take a look at my video looking at the differences and similarities between funds and ETFs. Now, the 3 funds you are going to include in your 3-fund portfolio are firstly, a global or international equity index tracker fund. The second one is a domestic, which means the country you live in, equity index tracker fund. And the third is a global bond index tracker fund. Let's take a look at choosing how to allocate across the 3 funds. When it comes to the allocation between the funds, let's assume that you've established for your timeline and your risk tolerance, you would like to put 80% into equities and 20% into bonds. This means that you'll put 20% of your portfolio into the global bond index tracker. For the equity allocation, you'll need to decide between the global international tracker and your domestic tracker. Now, I'm basing my analysis on Vanguard's funds for simplicity, but you could use any funds from Hargreaves or Fidelity or AJ Bell and the like that meet the structure and requirements that we need. The global bond allocation using Vanguard could, for example, be 20% in the Vanguard Global Bond Index Tracker. Now, this is a fund comprising 12,780 global bonds and charging an 0.15% fee. As regards that 80% equity allocation, when I took a look at Vanguard's ready-made lifestyle portfolios, they had allocated 20% of these portfolios to the UK. And on that basis, I would allocate 20% of that remaining 80% to the UK, for example, Vanguard's UK All Share Unit Trust. And this is a fund comprising 595 UK shares and charging a fee of 0.06%. The remaining 60% of your portfolio could be allocated to the Vanguard FTSE Developed World, excluding the UK Equity Index Accumulation Fund. And this fund comprises 2,043 stocks, mostly from North America, Europe, the Pacific, and the Middle East, and charging 0.15%. Choosing which index funds to select can be simple if you focus on a couple of key characteristics. Firstly, you'll want to keep the costs as low as possible, and you'll want your investments to be diversified and broad. Total fees per fund in excess of 0.2% dilute the benefits of the three-fund approach. And selecting funds that are too concentrated in a particular industry take away the diversification benefits. The final step in your approach is to set up your monthly investment amount. Now, the trick to investing success is to consistently contribute to the funds and give your investments the time to grow. On an annual basis, check your allocation between the funds and make sure that the percentages are still consistent with what you originally planned. If they are not, rebalance your portfolio by either contributing a little bit extra to the fund that has fallen below its allocated percentage, or by selling some of the funds that have exceeded their allocated percentage. Alternatively, you can simply not contribute to the overweight funds for a few months. In conclusion, the pros of this three-fund portfolio are its simplicity, its ease of getting started, and the added advantage is that it can either serve as your entire portfolio or as your core portfolio around which you can add some more interesting investments, such as individual shares, funds, or ETFs focused on geographies, industries, or initiatives that interest you. If you are ready to get started investing and want a little bit more info, grab the Investing 101 guide below in the notes. If you like this video, please let me know by hitting like and share it with any other ladies who want to change their financial stories. And if you find anything helpful, please put it in the comments. For financial education and money talk designed especially by women, because I am a woman, please subscribe to my channel and hit the bell to be notified when I post a new video. It's been great speaking with you today.